Thank you, Deepak, for doing this. In the past couple of days, rupee has, weakened, then strengthened. There are a bunch of things happening in the forex market as well. Before diving into what is happening with the rupee, I wanted you to first explain us as to how the whole market is sort of structured. Who decides the price of rupee, who trades it, and overall what the structure is.
Thanks, Krishna. Okay, forex market in India is a activity that basically involves banks, corporates, RBI, foreign investors, and so on. There is a significant participation by a large part of the banking system in this process. So what happens typically is, let us say you wanted to import something from outside and you want to make a payment in a month. So you want to make a payment in a month, it's a market. So prices are traded like the stocks are traded, right? So somebody makes a bid, somebody makes an offer, and that's a spot market. In the spot market, you say, I want this many dollars. Settlement is either T plus 0 or T plus 1. And you say, well, I'll give you 92 rupees, 90 paisa per dollar. You transfer the rupees, they transfer the dollars to your account, right? So the dollars don't get transferred to your account per se. So what happens is, because no bank in India can hold dollars in India, dollars are only held in the US. There is nobody else in the world can hold rupees. Rupees are always held in India. It may be held in India by a bank on behalf of someone else. So it is like your money always sits in your bank, right? You don't have it with you. There's no currency notes that are coming to you. You can take them out whenever you want, but typically the idea is the money sits in a bank of the country that owns the currency. So when you transfer dollars for a customer, what happens is that customer's account with some US bank, say JP Morgan or one of these banks, will get credited. They will be a corresponding bank in India. They have something called Nostro and Vostro accounts. So essentially it says a bank in India will have an account with the bank in the US. Just to give an example, SBI may have an account with JP Morgan, right? Somebody transfers the money to a customer in India. I go to SBI and I say, I want dollars from say a foreign investor, foreign institutional investor, Goldman Sachs. So Goldman Sachs will then transfer their money to my bank, which is SBI, whose bank account is with JP Morgan. So SBI is JP Morgan bank account. And my rupee account with SBI gets debited and the foreign investors India account gets credited, which may be with, say, HDFC Bank or something. So just the rupee transfers in India, the dollars transfer in the US, but essentially now I hold those dollars. I can instruct my SBI to say, pay my supplier, maybe it is, OpenAI or something, so many dollars, and that is done. That's a trade that is done, right? The bank is doing a trade on behalf of me. When it does this trade, it typically says, well, you know what, this trade is done, it's a pass-through. I trade with the bank trades with the Goldman Sachs or whatever. I don't directly trade with Goldman Sachs, right? So it goes through my bank. My bank then places an order. Goldman Sachs may place an order in the same thing, or Goldman Sachs may tell its bank, whichever bank it is, HDFC Bank or something like that, to place their orders correspondingly in the Indian forex market. That is your spot market. What if I say, listen, I want a 1 month forward. I don't have to pay them now. I have to pay them 1 month later, but I want a cover for that 1 month so that the rupee doesn't depreciate in that time. I want to fix the concept. So I buy 1 month forward. The forward is basically saying, I want the dollars, but I want it 1 month later, and I'll pay you the rupees also 1 month later. So everybody puts some margin money and all that stuff, which the banks do it between each other on the settlement portal. And then I get charged a different rate because I'm importing. I may get charged a higher rupee rate because it's 1 month later. Somebody's taking that risk. So they'll get paid for the risk. Plus, I'm not transferring the money right now. So there's an interest rate component of that time period. For the risk and the time period difference, there is usually a premium. That means if 92.9 is the spot price today, 93.1 may be the forward rate for 1 month, 93.5 maybe for 2 months. And it may be different at different times. Usually in a normal market, these price differences are very small. In a market like today, when the rupee is depreciating a lot, the price difference can be very large for 3-4 months. Typically, an interest rate in dollar terms of about 2.5 to 3% a year is considered while considering all of these ramifications, plus a directional call on the market. This is called deliverable forwards because eventually when the forward gets settled, it gets delivered, dollars get transferred, rupees get transferred, right? So you get a deliverable forward. Onshore on India, so it's happening in India in a forex market that RBI has awareness of and control over. That means it knows whose players are playing these things. They can see positions. They can see if there's a buildup of purchases of dollars. They know that. So how does the RBI come in? RBI is also a player in the market. It says, well, you know what, let us say the foreign investor wants to bring in $5 billion for some strange reason.
Foreign investor wants to bring in $5 million into India.
Yeah, $5 billion, let us say. It's a very big amount. Now the foreign investor will say, I'll bring it in. Now, if you're a trader in this market, you see a big order, you'll be like, Terko 92.9, so it is too much. Because you're giving me such a large amount of dollars, I have to take the risk on the rupee. The rupee will appreciate because now demand for rupees is high, supply of dollars is high. When you have a higher supply, the dollar weakens and the rupee should appreciate, right? So the guy who's buying it will say, it's 5 billion, then I'll pay you 92.1. Because there is no capacity to accept that much risk. So RBI will come in and say 92.9 and 92.1 is too volatile. Let me control this by saying, okay, fine, I'll give you 92.8, but I will buy the dollars. So RBI prints rupees and gives it to their Indian bank and takes the dollar in RBI's own account in whatever bank there is correspondent bank in the US. Because RBI has Forex reserves. So the Forex reserves goes up by $5 billion and new rupees are introduced into the system. Similarly, if somebody wants to take...
Sorry to cut you. This means the RBI is just keeping the rupee stable. It doesn't go anywhere else.
A rupee, because now RBI absorbs the supply of dollars. So when you have an equivalent demand for supply, the price doesn't change so much. To give you an idea that RBI is saying ki there is no supply, there is no demand because you are bringing in such a big supply. So instead of that, I'll come in and I'll balance the market out. Same thing on the way out. When somebody wants to sell rupees and buy dollars, the rupee will depreciate because they'll say 92.9 to nahi, I'll give you $1 for 93.5. This is a 60 paisa differential which RBI says is too much. Chal theek hai, 92.9 nahi, I'll give you at 93, but I will supply the dollars. So then what happens is RBI supplies the dollars, it takes the rupees. Any rupee that goes back to RBI goes out of the banking system. It is no longer available. Then the total available rupees comes down. Which is why when the rupee goes out, there's a liquidity problem. Banks are like, my rupees have gone out. I don't have any rupees anymore. RBI has taken it away and the dollars have gone to the customer. So now there is shortage of rupees in India. So RBI might do a temporary VRR, which is called a variable rate reverse repo, where banks can borrow from the RBI for 1 day or 3 days or 10 days, short-term periods, to add that liquidity. So RBI prints new rupees and gives it, saying you give it back to me tomorrow, the rupees will go out of the system. Then you borrow new rupees from me tomorrow and all that. Same thing, there is something, it's a variable rate repo, not reverse repo. Repo is when banks borrow from, it's called a VRR. So if banks have too much money because RBI has bought dollars and created new money into the system, RBI will then say, listen, I created these rupees, but now you have too many rupees. They're all rupees sitting in the bank's accounts with the RBI. It's a very complicated phenomenon, but these rupees are created inside of the RBI itself. And then the banks will say, I have too much rupees, I want to give it to you for overnight. Mein kahin to at least I should be able to get some interest rate. So RBI says, okay, you park the money with me. It's called variable rate reverse repo. Reverse repo is when banks park money with the... So excess liquidity means VRR is high. Effectively banks parking money with the RBI. Less money means banks borrowing money from the RBI. To give you an idea, since 2016 or 17, we've mostly had banks parking their excess money with the RBI.
Banks parking excess money with their RBI over and above SLR, CRR and all of those things.
SLR is different, SLR is just investment in bonds, but CRR is basically 4%. So you need about 8 lakh crores today to meet CRR. That's the total banking system requirement. If banking liquidity is 11 lakh crores, that extra 3 lakh crores is sitting extra on the bank's books in the RBI. So they say, okay, keep 8 lakh crores for CRR. The extra 3 lakh crores, please give us interest on every day. That's called, there are many ways for it. It's called STF. There's a VRRR, slightly different. So the reverse repo is what happens. If banking system liquidity is less, so let's say only 7 lakh crores is there, then banks will borrow 1 lakh crore from RBI and meet their CRR requirements. That 1 lakh crore they'll pay interest on a daily basis. So the system is either in surplus or in deficit. That is the RBI part of the equation. So what does the RBI do? It participates in the Forex market. It creates new rupees or takes away rupees as whether it buys dollars or sell dollars respectively. This is the onshore market. There's lots of restrictions in the onshore market. I cannot just randomly buy the rupee dollar just like that. I used to be able to, but FEMA says it can only be done for genuine corporate purposes. Unless I can prove that I have an export, I cannot sell dollars. I have to go to my bank with documentation saying, listen, I'm importing this. This is the invoice. This is the bill of lading. This is the thing. I have to open an LC and all that stuff. If I have all this documentation in place, bank will say, okay, you are a genuine importer. For this import, I will give you this spot or rate or this forward rate or whatever it is. Same thing can go. An IT company can say, listen, I'm getting this much money every month. I want 1 month forward, 2 month forward, 3 month forward from now on. Where I want to hedge maybe 50% of my inflows. When I say hedge 50% of inflows, bank will quote a rate saying for 1 month I'll give you so much, for 2 months I'll give you so much. They do the corresponding trades in the Forex market by saying, listen, against this was a customer demand, so I did this. But banks can also play in the forward and rupee in this market by creating trading positions, because you need traders to create liquidity. If you only depend on this thing, so service exporter may say, I want money on the 15th. The importer may say, I will import on the 25th. So 15th ko, where do you get the dollars from? Who owns that in the meantime? So the banks own it. They keep it on their books as part of their trading and treasury portfolio, saying, we will do this. We will take the dollars in our books. We will hedge it and all that stuff. So banks are allowed to do this in a trading part of their part of their business. Corporates are not allowed to do trading on this kind of thing. FIIs, on the other hand, have inflows and outflows. They keep saying, listen, we'll bring in money when we want. We want the rates. They will keep bringing in the money whenever they go. So they're foreign players, they're Indian banks, they're foreign banks, there's RBI. All these are players in the market. Corporates are also there, but corporates are genuine demand in that sense. What happened recently was that a new market started to form outside India called the NDF, non-deliverable forward. I told you about deliverable forwards. Deliverable is on the day of expiry, dollars are exchanged, rupees are exchanged. What if I told you that let's bet on the rupee in dollar terms? So we'll bet that rupee will be, in 1 month, it will be 93.5. I am willing to buy rupees at 93.5. You must be willing to sell rupees at 93.5 to $1. But we don't have rupees. This is offshore. So what I do is I say, listen, it's a percentage difference. No, I will pay you the percentage difference in dollar terms only. We will not involve the rupee at all. It's a non-deliverable forward where there's no delivery of rupees and all happening. It's a cash settled position. So in trading terms, it's like buying a Nifty future. If the Nifty future expires, you don't get Nifty stocks. You just get the cash equivalent to the difference between your buying price and the expiry price, right? It's called a cash settled option. But you never got the Nifty. You bought the Nifty future. You effectively let it expire, but you only got the cash difference. Think of the same thing happening on the rupee. They're saying, I'll give you $100 at 91. You give me $100 at 91. If it ends up at 92, so you're the buyer, I am the seller. I sold dollars today, so I have a loss. I sold dollars at 91. Currently, it's at 92. So I have to pay you the 1 rupee difference, but 1 rupee is equal to maybe 1.1%. So if I did $100, I'll pay you $1.10 as the difference. That's the cash settled differential option. So there's no $100 changing hands. There's only this 1 rupee $10 that changes hands. It's a bet on the rupees move, right? This is the non-deliverable forward. It started to get a lot of acceptance because people said, listen, at least we can hedge over there. Here we have to put lots of documentation in place. They have to ask us, how much money do you have? Do you have this? I don't know. Tomorrow I might decide to sell and then I will get the spot rate of tomorrow. I want to hedge today. Since I cannot produce documentation in India, let me set up a non-deliverable forward outside and that will be my hedge.
So banks set up the shops outside, which is offshore, banks, corporates, and all of these guys, or just banks?
Think of this is a foreign investor. Foreign investors are anyway outside. He can set up a non-deliverable forward outside completely. Who's on the other side? The answer to who's on the other side is typically it's a foreign bank. A foreign bank has operations in India and it also has operations outside India. The foreign bank's treasury operation can say, I'll do the non-deliverable forward and I will take a corresponding position in the Indian market if I want.
Oh, okay. So arbitrage essentially then.
Arbitrage, right? So now since the foreign banks were doing the arbitrage and they had a certain level of liquidity available, the rupee started weakening a lot in the non-deliverable forward market. Realizing this, the RBI said, it doesn't make sense. Why don't we allow our banks also to do it? So they said our own banks can play in those forward markets up to 25% of their paid up capital or their tier 1 capital, which means that you can go and set up positions worth that much. So banks went and said, oh, we will, you know what, if there is a arbitrage between there and here, I will buy dollars in India, I will sell it in the NDF market and we'll make the difference. So I am hedged because I have both positions, but one position's offshore, one position's onshore.
RBI is okay with the offshore activity that is happening, which is why they have allowed banks to do this?
No, it's like, tomorrow if somebody bets on an IPL match, what will the IPL do about it? I am betting, you are sitting somewhere, what will you do? I am betting that Nifty will go up, right? And I'm going to pay you in dollar. So I'm not buying the Nifty. It's like what is called a dabba trade. You're trading the screen price, but you're not actually making an underlying trade. So the whole NDF market is the suited, booted equivalent of a dabba trade. So since the NDF market is like that, RBI is saying, if that is an important market, then why shouldn't we also play in it, link it to the real market so it becomes less of a dabba trade. So allow the arbitrage between the Indian market and the offshore market to happen with Indian banks. So Indian banks could go and play that game, right? Now, what happened recently was a large amount of selling of dollars happened in the non-deliverable forward market. Remember, I don't have to put any money down there. If I'm betting on the rupee to go down 1%, I can say I will buy dollars and sell rupees effectively today at 91 rupees or 92 rupees, okay, 93 rupees, because I expect it to go to 94 rupees. I never have to put 93 rupees or even $1 on the line. Let's say I buy $100 million of position, right? $100 million, I expect to earn 1% out of it because I expect the rupee to decline 1%. That means I expect to make $1 million. So what do? I take $100 million position because I'm going to earn only 1 million out of it, even if I'm right. Worst case, if I lose, also I lose maybe 1 million. So it's only a million, right? So I'm playing these large numbers, 100 million, 200. So there the things balloon to 5 billion, 10 billion. But when you have 5 billion, $10 billion positions, your effective gain or loss is only one. If for a 10 billion position, 1 million is about $100 million, 1%, right? So you're making a bet on making or losing $100 million, but you have a $10 billion position. In India, if you actually set up a forward, eventually you have to put the $10 billion also. It has to come. It is a deliverable forward.
Right. Underlying has to be there.
Yeah, underlying has to be there. So that means somebody has to produce $10 billion on the day of expiry. And somebody has to produce $10 billion equivalent of rupees. $10 billion equivalent of rupees is about 93,000 crores. So somebody has to give 93,000 crores, somebody has to give $10 billion. That doesn't happen in a non-deliverable forward market. So the numbers there are higher. It's the same as saying options notional value in a stock market is 600,000 crores. There's no 600,000 crores changing hands. Only the premium is changing hands, right? It's a tiny amount compared to what it is. That's why options participations to look so large. Same thing with the NDF. NDF looks very large now because it will become larger and larger and people are using it for hedging, but also using it for speculative activity. RBI said the banks can go and do this. Now the banks started to do this. Banks started to do this big time. So in the last few weeks, when the rupee weakened a lot, the NDF levels were increasing because people were trying to buy dollars in the NDF market thinking that the rupee will fall. And the rupee was falling. So what happened because of the arbitrage, the bank said, oh, fine, let us sell dollars in India and buy dollars in the NDF market because there it is 93.5, here it is 93. So I'll make the 0.5 difference.
All the banks will make the difference. Yep.
The bank will make the difference. It's like saying I'll buy in NSE, sell in BSE. There's a 50 paisa difference. Doesn't matter where the rupee goes, I'll always lock in that 0.5, right?
So the essential bet was that the rupee is going to fall, so let's buy dollar.
That is, somebody on the other side has taken the bet. The bank is taking the bet that there's two prices of the same instrument. In India, I'm getting at 93. There, I may be able to sell at 93.5. So I buy dollars in India and I sell dollars in the NDF market. Now, because of this, banks started earning a lot of money. But what happened was, in India, dollar sales were happening. And this is not genuine dollar buying. Right? It is buying only for the speculative activity. But like I told you, the NDF market can have huge volumes, can have $100 million, $200 million, $5 billion. The guy on the other side is not putting $5 billion on the line. He's only going to play the difference. For him, $10 billion means my exposure is maybe 100, 200 million at max. For the Indian guy, it is 10 billion because he's actually setting up a $10 billion position in India. In India, when you do $10 billion of purchasing of dollar, who's going to give it? RBI is going to be like, dude, you'll destroy the price. I'll give you 10 billion. So RBI loses its reserves by giving those $10 billion here. There, they are setting up the position with hedges. So RBI said, this is nonsense. I want to limit your participation to only $100 million per bank. So an SBI, for instance, came out and revealed that it had a $5 billion position. 2 weeks ago, they came out on the Friday and said from Monday onwards till April 10th, please reduce your positions to $100 million. Now, when you reduce the positions, what will you do? You'll do the reverse trade. You had bought dollars in India, you will sell dollars in India, and you will buy back the NDF. And because the NDF prices are still divergent, they were 50 paisa when you got in, now they are 90 paisa, you will lose that 40 paisa as a banker, because now you bought the spread at a wider rate, you have closed the spread at a wider rate. The 50 paisa is not allowed to, because there's still 3 months left or 2 months left in the contract. You have to close the contract right now. The contract is closed at a 40 paisa loss to you. Now, banks didn't want to lose all that money. So they went to corporates and said, hey, you have a ton of imports. No, take contracts from us. You didn't want to hedge it earlier. See, an importer may not necessarily want to hedge. An importer says, it's okay, I'll take the ups and the downs. I will not hedge. I have set up some hedges with the banks, but not enough. So the banks will go to them and say, listen, I don't want to lose all this money. Why don't we transition these positions to you, where you do this, and you also have a foreign arm. So you can take the NDF position from me in the foreign arm. You can take the Indian position from me in the Indian arm. So they went to multinationals, to corporates and all that, and transferred this entire risk to them.
This still sits in the bank's portfolio, right? It doesn't happen on the corporate.
It has happened on the corporate.
But you had earlier mentioned corporates can't play this. It's only banks who can do this.
They can't play the speculative game, but they can say, I'm genuinely importing. So I have a genuine need for a forward. And they can go and hedge it in the NDF books with their foreign arms. The foreign arms is not visible to India, so we won't even know that they're hedging it. But the banks have the relationship, so they'll move the money to corporates, to finance companies, to FIIs, all of that will happen, right? So now it looks like the bank's customers have now taken over these contracts. So no dollar was actually sold in India. The dollar which was bought by the banks, were sold by the banks to the corporates who bought it at the same rates. Now the banks will make that arbitrage spread. The corporates will make that arbitrage spread. Banks were like, fine, as long as I don't lose any money, I'm fine. So that one day, rupee opened up 1 rupee lower, with market players thinking this will happen. And within the day itself, the entire corporate guys had come in and they bridged that gap. Rupee still stayed at 94.5 or 94.6. It was 94.7. It went to 93.7 and then came back up to 94.7, right?
Because corporates.
RBI said, what the hell? You guys have just gamed my entire system. Nonsense. I'm going to find a different way. They said, fine. The $100 million is limited. But you guys have taken imports against some import documentation, right? That's how you've given the corporates this thing. Why don't I say that from tomorrow onwards, you cannot book any NDF contracts on behalf of customers for those corporates that you're serving, even outside India. And you cannot renew, because sometimes what happens is they will take a contract, they will cancel the contract and rebook it. You cannot rebook it because they'll be like, oh, okay, you know what? Let me cancel this contract and then I'll rebook it on the same import. So I'm importing 100 million. I took a forward, then I canceled the forward, then I took another forward on the same import. So on that same import, you cannot do it. It's a different import. That's a different thing. But on that import, you cannot. Once you cancel, you stay cancelled. When they did this measure, essentially the corporates were like, hello, we can't take now this entire risk on our books, and you can't sell us NDF anymore. So we will bridge that gap by closing out the contract entirely, and some deal will happen where the banks lose money. Now, the banks will obviously have a quid pro quo deal in terms of who makes that arbitrage and all that. But eventually, this entire thing had to be unwound. And when it has to be unwound to the 10th, today we're still the 8th. So it'll take some more, it'll be there for another 2 or 3 more days. The NDF market started to recognize this, and then, the spreads between the India and the NDF, obviously, the arbitrage tries to bring that gap down. When you try to break this because of the regulation, the gap will widen. So the gap widened to as much as 1% or a lot, not 1%, but a fairly significant number over a few days. And then eventually it will stabilize. But where will it stabilize? That's the question. So now if you're getting lower oil prices, then Indian demand for dollars, as many dollars will reduce, right? So the number of dollars required to buy the same amount of barrels reduces. So demand reduces. So rupee gets slightly stronger. So the genuine demand changes in that sense. So that will also bring down the rupee, bring down the dollar versus the rupee. USD INR rate will fall. And also if foreign investors start investing back into India, the dollar rupee will, till now they've been exiting. Even the last 3 or 4 days, they've exited more than 25,000-26,000 crores. So that much money has gone out. Part of it was to help and try and make this arbitrage happen also. I'll sell my Indian stocks, I'll take the dollars from here, genuine demand. Then I will set up the NDF over there, which is also genuine demand. I'll do the arbitrage spread between the two, right? Even the FIIs will play the same game, saying I'll sell the stocks in India, I'll buy back later, come back later and buy. The FIIs also don't want, now they don't, if they've sold at 100 rupees over a stock, when they sell it, it falls to 98. Then they're thinking they'll come back and buy it at 98 when this arbitrage gets over, which is maybe 2-3 months from now. But now they're seeing that the 98 rupees stock has gone up to 104 rupees because the war is over and whatever. They're like, oh man, you know what? I did a 3% arbitrage, but I lost 6% on the rupees that I have lost by having to buy back the same stock, which I liked at a higher price. So they've net lost in that arbitrage. They can hedge it somewhat by doing some futures trades, this, that, and all that. So there's a complex things that they do. But by and large, if the rupee appreciates onshore, it affects the NDF also, because the NDF expires at the rupee's onshore rate.
Because it is a derivative of that, even though not in real terms.
The NDF has been set up that way, saying we will expire at the rupees onshore rate. So you see, one day NDF maybe at 92.61, and each NDF contract has a expiry date, right? If it's one day, that is on 9th of April.
How long is it usually?
It can be as much as 1 year, 2 years. I mean, you can do anything. It's a negotiated contract, right? So, but when you report it, it'll be like, oh, I did a 3-month NDF, I did a 4-month NDF, and RBI has a page that shows the different spread, different rates for different. So what is the weighted average price for something that is 1 week? So there may be 100 contracts. They'll take the weighted average of that and say, oh, 1 week is 93.2. Right? So 1 week at some point was 94.5 and 1 day was $92, $93. So there's a fairly big gap. That gap has now come down, mostly because today there was some indication that the war is nearly over.
But we never know.
But again, we never know. So the crisis continues. However, this spread has come down now, but it had widened quite a bit in this thing, and you should expect more volatility, that the NDF markets will have different players. NDF markets can be used to manipulate stock also, easily. If you allow the arbitrage to happen, remember the arbitrager has to put significantly higher capital compared to the individual player who's only speculating in one direction, because the capital that the individual player is putting is on a forward, which is relatively small. The Indian player has to have the ability to service contract, which is $100 billion or $10 billion, $20 billion. They may have low capital now, but on expiry day, they'll have to kind of negate that trade in some way, right? To that extent, there was a speculative overload in that. And when you remove the speculative overload, you got a different pricing. So it may change backwards also, because some of the fundamentals of the rupee remain a little weak, because we have a lot more imports in terms of crude oil compared to maybe February or January, where the prices were 60. Even today, after the drop of the price, it's at 95. Yesterday, we bought oil at 125. The prices that we pay for oil, maybe it creates that feeling of, because crude is our largest import, it has the greatest impact on how many dollars we have to buy every month. To give you the same example, tomorrow if India discovers a very large amount of oil, so much oil that we have to import half our crude, the dollar demand will be cut substantially. Because now demand for crude is no longer external, it is internal. It's a little sensitive to crude price in that sense, right? That is one. But the other impact is also that maybe perhaps because of what has happened, some of the remittances that were supposed to come from the Gulf may be delayed. So the supply of dollars becoming lesser and lesser, demand for dollars isn't. That's why the price fundamental this thing. Yeah. So the NDF market may be more some speculative players who believe the rupee will fall, and maybe some hedging demand from corporates who have exposure to India, who don't want to go through the documentation pain that Indian banks require because of RBI rules. When situations get better, when foreign investors want to come back to India, you'll find that this NDF spread also narrows quite substantially.
So a couple of questions now. So the rupee has strengthened now, let's say for now, because of whatever the RBI has done. Let's say first, which was capping the percentage to 25% of the capital and then stopping corporates to not do the NDF thing. Will RBI open this up again? The other thing, how long can this be sustained? I'm guessing this is just one of the tools that RBI uses to stabilize the rupee or make the rupee more stronger.
It's cutting speculative demand to some extent. Banks were in that sense bridging that gap, and RBI probably believes that a lot of that gap is unnecessary speculation. So they've removed the ability for Indian banks to do this. Foreign banks can continue to do this because they are not under the control of the RBI. Foreign banks only the Indian branches are under RBI control, right? The foreign banks banks may have NDF positions on the rupee separately. That is their problem. So they may still continue to be able to activate. Indian banks can no longer do it. And that changes the equation in terms of the number of players that are able to do this arbitrage in the first place.
So liquidity goes.
Liquidity goes, and the corporates cannot replace the banks, because banks cannot just say, listen, I'll give this contract to you, but don't worry, I'll take the loss, I'll take the profit. Nothing happens to you, but because I cannot hold it on my book, you hold it on your books. That is no longer possible. So now that the arbitrage has completely vanished from this end, it can be only genuine demand that changes hands. If genuine demand comes in, then it will definitely reflect in both rates, rupee onshore and rupee offshore. But if there is been a primarily speculative demand, it'll bridge. So what it means is, if the rupee is fundamentally weak, the rupee will continue to be weakened. It'll go from 92 to 93 to 94 or whatever. But if this was only a speculative push, then to that extent, the rupee will appreciate and go find its normalized level. Maybe it will 91. Then it'll go to 91 and stay there.
Other thing, my question was that this is just one of the tools that RBI has, right? What other sort of tools are there in its toolkit that it can use to sort of stabilize the rupee or make it stronger, weaker?
For one, there are investment restrictions in certain areas which it could lighten. It can increase the demand for, it can supply dollars to the ecosystem by itself. I said the problem there is then you take away rupee liquidity or deal with rupee liquidity. But if it were to supply enough dollars, then some of the genuine demand also will be addressed. It has done a lot of measures. Then most of the financial measures, I think you want more open markets, even if there's speculation. It's okay to have speculators. So this kind of a thing is a stopgap arrangement. Eventually, we'll have to find a way to kind of absorb all of this. But to that extent, your measures may only be temporary. There'll be others ways to do this, like to create more players in these Forex markets who will be able to. So for instance, you and I are not allowed to trade.
Right. We don't hold the underlying thing.
Then for this, the government has to change the FEMA Act itself. So if you change the FEMA Act, the rupee can be, it's a great time. Internationalize the rupee straight away. Take away the restrictions and allow everybody to participate. Allowing only banks to participate creates a problem. That is a good thing. But, I think we went the other direction, saying we'll let nobody play. The eventual goal has to be let everybody play, make the rupee completely open, and it's fine. But for that, I think we'll need a big crude oil discovery. Hopefully, that will also happen soon. And then we'll have less dependence on crude, and then the RBI will have less issues with genuine demand. Speculative demand will come and go. That is fine.
So just one last question. I'm just wondering, till when can RBI keep this cap and all?
What we don't understand is the RBI has been buying dollars to not allow the rupee to appreciate all of these years. Till 2024, RBI was a net buyer of dollar. In fact, 2024 also.
2024.
Yeah, every year it bought dollars because it didn't want the rupee to appreciate. If we wanted that, and that was fine, then why didn't we want the other side? Right? If we wanted the RBI to not let the rupee appreciate, then why should we argue that the RBI should not let the rupee depreciate? It's nonsense. We've been net buyers of dollars for the longest time. Our current account deficit was $50 billion last year. It will probably be 65, 70 billions. At max, it's $100 billion. We have more than $600 billion. Current account deficit otherwise is $50 billion. If you take 600, it's 12 years. Current account deficit. We don't need this many dollars to be sitting in the RBI. RBI bought more because it says, I don't want the rupee to appreciate so much. If you had let the rupee appreciate, we would have been at 75. That would have depreciated to 95. Then it'll go back to 75 or it'll go back to 60, then come back. Let it go, no? After a while, the pendulum will swing lower and lower and lower and you'll find the ideal price. But you have to be willing to live with rupee volatility for a long time. And now you have $500 billion. You can place that as, and you should internationalize the rupee more, saying other countries can use the rupee in different ways. Iran could take rupees to buy dollars and Iran can use those rupees to buy stuff from UAE. Why don't we allow that? Of course, Iran has other problems like international sanctions and all that. But let's say those sanctions came off. Why can't we internationalize the rupee? Because Iran doesn't want dollars. Iran wants to deal with non-dollar currencies. Then Russia wants to deal with non-dollar currencies. We should use those routes to make the rupee more attractive, but we don't. And it's our own rules that restrict us. So I think over a period of time, if you want to internationalize, you will have to both internationalize the rupee and open up to a lot more players playing into these markets. And it is a speculative market by definition. Any market that is not speculative is not a market. It has to be speculative demand, and you have to encourage it, because genuine demand doesn't have synchronicity, which means the demand may come in the morning, the supply may come in the evening. What happens in the interim? Some speculator has to take that bet and put their capital. You need the speculators, otherwise you don't have a market.
Got it. All the questions that I had. I still have a bunch of things. I'll save it for some other conversation next time that we have you. But thank you so much for doing this.
Thanks, man. Cheers. Take care.